I think in the city leasing market, certainly on the ground, we're starting to feel more activity and more signs of life coming through. It hasn't translated through yet into the first quarter stats. We've only seen 805,000 square foot of take-up so far this year, but more importantly, there is 1.1 million square feet under offer, and I think the confidence is slowly returning through and tenants are starting to become more active. We're definitely seeing more signs of pent-up demand increasing, and we're now seeing total demand sitting at 10.1 million square feet for the city alone. Some of those tenants that are starting to dust off plans again, such as Schroders, Investec and Cameron McKenna, that have placed their requirements temporarily on hold, will also add further credence to an improving market. More positive signs are that rents are holding fast. Prime rents are still sitting at around £55 a square foot, and whilst there is good activity at the smaller end of the marketplace, we are seeing rents in new refurbished product hitting the early 60s. And I think if you look at some of the deals that will be announced over the next few months in terms of the iconic towers that are being built, the likes of 20 Fenchurch Street, we will see rents certainly in the low to mid 60s being announced, which again will be a very positive sign for the city market. City incentives over the first quarter of 2012 have remained relatively stable. We have seen some pressure where landlords are keen to try and get the transaction across the line. So over the next 12 to 18 months we're anticipating a reduction in incentives being provided, and principally as a consequence of constrained supply and increased demand. I think if you go back in history, tenants have tended to remain within their designated areas, whether it be media, banking, finance, insurance. However, I think with the emergence of new destinations across central London, the improving transport network and the impacts of what we will see with Crossrail, combined with lower property overhead costs in the more fringe locations, are now attracting a lot of occupiers to start to think about their locational requirements and where they would be prepared to be based. This has been particularly prevalent in the TMT sector, and we've seen a number of big requirements coming out of the core West End and starting to look into more fringe city and fringe West End locations such as King's Cross, Farringdon, Spitalfields and the likes. And in terms of going forward, I think we'll also see good activity in London Bridge, north of Finsbury Square and around Farringdon as being some of the hotspots.